eWorld Kickoff is starting the eWorld season, and I have prepared a little slide for you to give you a quick overview. Yesterday, we talked about energy policy in Germany. Today, we will zoom out and look at global gas markets. And tomorrow, we will come back into Germany and have a look at heating and especially how to go with the heating transition in Germany. That's also very gas related in Germany. So today, I'll just browse over our program today. You have seen we have a discussion panel later on. We will be there in just a few minutes. Before that, if you have any questions, just the last technical detail, questions can be asked in a chat. So just write them in. You find it just right on the right-hand side of your screen if you're following the event in the eWorld community. Just type it in and I'll hand it over to our host, my co-host today. He is again a Berlin correspondent, if you will, and he's a renowned gas specialist and gas markets analyst. I think if you have been following, or if you are following the trade press, I must have come across some of his articles. So, welcome to the eWorld Kickoff, Heiko.
Okay. Thank you very much, Anna. I take over. Saying good morning to all of you on your screens. And an interesting introduction of Anna to say, well, we are discussing global gas markets in the transition to nowhere, and so that we can go away now for coffee. But perhaps, as Anna said, it might be worth thinking a bit more in detail about the gas market transition after the curtailment of Russian gas and between a new market equilibrium, security of supply, and decarbonization issues. I'm going to discuss it with four very distinguished participants. The first is Jonathan Stern. He is one of the best-known academics, researcher for gas. He's long worked with Russian gas, but not only, and is one of the founding fathers of the gas program of the Oxford Institute of Energy Studies. Good morning, Jonathan. The next is Yuri Domokos Varga, who is the CEO of MET International. MET is one of the large trading companies based in Switzerland, which has its origin as a trading arm of a Hungarian gas company, state-owned gas company, MOL, but which is completely independent of MOL now, and one of the global players in not only in gas, but only in energy. Yuri, good morning to you. Kirsten Westphal, the member of the BDW Executive Board, is the third one of my list. Kirsten has a long track record as a researcher in the Stiftung Wissenschaft und Politik, SWP, one of the leading political think tanks in Germany, and she worked for years on global questions of gas and energy and global energy security. And then after a short interregnum at H2 Global as one of the managing directors, she switched to the German Association. Last but not least is Georg Sachmann, senior fellow at Bruegel, a think tank, or Bruegel, a think tank in Brussels. I never know how to pronounce it. I met, I think, Georg first when we fiercely debated the pros and cons of Nord Stream 2, but I think this debate is obviously over now after explosions in the Baltic Sea, and Georg and his colleagues are putting together a very interesting and very helpful analysis and data about the development of the European gas market, in particular after the curtailment of Russian gas. Good morning, Georg, to you also. I think I forgot to say welcome to Kirsten. Without any further delay, I think we're just going to start, and I start with Jonathan. Perhaps what is one of the focus is what is the future balance of the global gas market? And you're an expert of Russian gas. You work very, very long with Russian gas. And one of the questions which I'm asking myself is whether the global gas market will rebalance just because Russia is able to ramp up rather quickly to replace supplies to Europe, to supplies, additional supplies to other countries around the world, in particular to China or Turkmenistan, other countries, in order to ramp up LNG supplies to the world. Is that really a feasibility, Jonathan, or will Russian gas will just missing to the market for in long term?
Thank you, Heiko. So, hello, everybody. I think the answer to that is, in time, there will be a rebalancing, and part of that will be due to a resurgence of Russian gas. Let me just focus on the plans that the Russians have. If we think that Russia exported somewhere between 170 and 200 billion cubic meters of gas to Europe in the last few years before 2022, the plans to export pipeline gas to China, Power of Siberia 1 to China, is going to achieve 38 billion cubic meters by 2025, and then possibly an extra 10 through the Sakhalin pipeline within the next couple of years. The question then is, what will be the future of Power of Siberia 2? That is the pipeline that the Russians are trying to persuade the Chinese to accept from Western Siberia, which would be another 50 billion cubic meters of extremely low-cost gas. So if those were all to happen, then we would see about 100 billion cubic meters of Russian pipeline gas to China. But I think it's unlikely we'll see all of them in place before 2030. So probably around 50 billion cubic meters in the late 2020s is probably the right way to think about it. But LNG is a different story, because what sanctions have done is to persuade and force the Russians to develop their own proprietary technology. And now we have about 40 billion cubic meters of LNG exports from Russia. And if the Novatek plans for the 3 trains of Arctic 2 go ahead as we imagine, that will rise to maybe 60, 70 billion cubic meters. And then if the additional plans for the 3rd train of Sakhalin 2 or Murmansk LNG or Baltic LNG materialize, then that will go up very significantly. So I guess my answer to your question is, yes, in time, it may be that Russia will be exporting 200 billion cubic meters of gas, but probably not before 2030.
That means after 2030, we will have a big going down of gas prices because we have a huge oversupply.
No, I think that will happen before 2030 because of the surge of LNG over the next 3 years. So our model shows more like 2026.
But that was that when we come back to that. But just one additional word, because as far as I understand, there are attempts of the U.S. American administration to put some sanctions on using the Arctic 2 output, which is coming on, which is supposed to come on stream end of this year, beginning of next year, with a decent volume. Will that add additional turbulences to the market because the Russians will have problems to sell the gas, or will it work like in the oil business that at the end of the day they find some outlet?
Well, don't forget that many of the LNG importers are not great supporters of US sanctions. So China, India, the big issue with sanctions will be Japan, because of the Japanese participation in the operating project for Arctic 2. My guess is they will get around that problem.
Okay.
But that you have to be an international lawyer to really have a definite professional opinion on that.
You're not an international lawyer, but an international trader. But first, what changed your trading lives after the curtailment of Russian gas? Was that something structural new? What happened afterwards, or is it more or less business as usual at different price levels?
Yeah. Do you hear me?
Yeah, I hear you. Perfect.
All right. So maybe it makes sense to differentiate two periods. One period is let's say starting with end of or Q4 21, and then a second period mostly during the summer, or maybe start of the summer 2023, because the first period is a period of crisis, and this is what we've had to live through, all of us, basically, companies, but also as individuals. And this crisis has been probably ignited by the lower Russian gas arriving and a lower fillage of storages for during 2021, and that has been basically taking its full extent during 22 as part of the war, then the Nord Stream shutdown. As well as there has been a substantially lower power generation from hydro, from nuclear, also from other renewables. So the gas crisis was also coupled with a power crisis to a large extent, which then fueled the margining crisis as well. So it was like everything thrown in the same basket in 22. But starting with this summer, when some normalization around the fundamentals happened, also around power and also around margining, we see what the new world is likely to be practically in the next couple of, well, I'm not going to forecast how long this is lasting, but basically we see about 100 billion cubic meters less Russian gas, and substantially increased LNG imports and demand destruction. So this all means that there's a new sense of volatility practically in the gas markets compared to before the crisis period, which is practically the loss of baseload volumes. And the baseload volumes we are trying to plug however we can. We plug with LNG, but then we import LNG volatility into the European gas markets. But also we export the volatility to the LNG markets from Europe. So due to the fact that the loss of the baseload volumes has basically upset global flows on the short term, we are all globally facing a new set of volatility. And
that is a new equilibrium, this kind of higher volatility, or do you think that it's phasing out to a new more stable environment over the next years?
So we are still not at a phase of equilibrium. Definitely not. Not until what Jonathan also said, 2026. There's a lot of new LNG supplies coming into the market. Now we are set by like a range of prices that is set by more by demand elasticity than anything else. So there's a lot of demand that Europe has priced out during 2022 from regions that were not able to manage these price levels anymore. And now we are basically in the volatile period of until a baseload supply is coming back to the global system. We're going to see impact of the winters, right? How cold they are, the impact of renewables, impact of maybe delayed demand response from industrials. So this is a search to equilibrium. This until 26.
Do you have a word on this Arctic LNG issue? Is that something which is that an issue or a topic for you anyway? That the question to what extent and when these LNG is going to the market, or is that something which is not really in your focus? I say it's just part of the normal daily life in a new volatile world.
Yeah. Well, I'm also not an international lawyer.
No, but you're a trader, and you have to. Of course, you have to. It's not a question of being a lawyer, but a question of the question is: does that add some uncertainty to your trading life, or is that something which is so tiny that it's not really matters for your trading activities?
Yeah. So the way we're forecasting LNG imports at the moment is also subject to the European fundamentals.
Okay.
And Arctic 2 volumes would have been an addition to the global LNG mix.
Mm-hmm.
Of course, its location would determine, from a shipping perspective, flows to Europe. But a large extent of the volumes that Europe is importing via LNG is also priced on a spot index basis. And since there's just so many uncertainties around the European gas balances, this individual item is not impacting from a pricing perspective, and
okay,
we don't pinpoint it as a separate item.
Oh, that's okay, perfect. That's Kirsten, from a downstream perspective, from a German end user market perspective, at least until 2021, Russian gas was always perceived as a major pillar of security of supply. It was baseload supply, it was the bulk of pipeline supply. How secure is Europe when it's relying more on energy? What does that mean for security of supply for the downstream markets from the perspective of an association like BDW?
Yeah, I should maybe say that
from your personal perspective. That's
exactly that I'm talking more in my personal capacity.
That's okay. Yeah, so makes that caveat, but you have enough experience in these kind of questions.
Yeah. But I mean, as Jonathan Stern and Georgi Varga have said before, how could you talk about security of supplies if you have really the loss of base load? I think we are really in a very volatile market environment, and both have said that, so that we have to look at the different phases. And I like very much the distinction from Q4 2021, where we had really not only a supply crisis, but really a suppliers crisis in Germany. So that had huge shockwaves into the German market, of course. And now we are seeing more the market fundamentals. And I'm coming back to what the IEA has said. I mean, we are really in a first global energy crisis, and it's still fascinating to see how the reshuffle of gas flows happens, and how this is organized. And of course, if we talk and if we analyze that as a real first global gas crisis, energy crisis, then of course Europe and Germany in particular are and have been in a perfect storm. Because just imagine, if you look to the flows into Germany, how they have come down. We have now 52% lower flows of Russian gas and of gas into Germany, than compared to the period of last year. Our own production is lower, so that is really a challenge. And if you look to the flows from Russia, I mean, they have come down from 64% in summer 2021 to 0. So that does really mean a Copernican change, so to say, in the German energy and gas market. And that's something that the companies have to deal with, that poses a very particular challenge to, of course, the gas transport system, where we still have challenges to bring the flows, to organize the reverse flows, but also bring the flows from the west to the east. So that is really a point, that supply security is far to be seen. What is important to say so is that, of course, we have now the situation that we are more immediate in the international market. What I mean by that is that, of course, the infection of what happens in the international markets is much more immediate. And Germany, you see, if Australia cuffs, if there are strikes foreseen, we immediately see the price hikes in Germany. So that is the situation. But of course, with the outlook, and the previous speakers have said that with new LNG lines coming on stream, 2026, 2027, the market might get more balanced. So just to be clear, the supply security situation is not relaxed. It's not tight. It's, I would say, still precarious if we look to the upcoming winter. And of course, it depends on the weather, on the temperatures, and if we see more disruptions in the geopolitical world. And the black swans are obvious, they are there. It's not just the Russian flows still via Ukraine, via Turk Stream, but it's also the whole situation in the Middle East.
But on the other hand, touching again on this topic of security supply, is the development of the last 15 or 24 months not at the end of the day showing that a rather open European gas market with diversified infrastructure, very capable network operators, shows how robust and, well, to some extent resilient the market is to these kind of changes. That means that at the end of the day, it's a market that provides to a large extent security of supply, or do you think that it's more a question of state interventions?
Of course, the markets have worked. Of course, we had the issue of the German speed with building the LNG terminals, the floating storage and regasification units. So yes, markets have worked. This is a sign, but I mean, I think it's fair enough to say that we were very lucky last winter. First, because of the of the mild temperatures, and then also because, as someone has put it, we were also rich enough to be lucky because we bought a lot of LNG volumes from the global markets.
Okay, Georg, last but not least, you worked a lot on the demand destruction that was already mentioned, but as far as I understand the role of Bruegel, you also focus on the relation between gas supply or gas demand and decarbonization. Kirsten already said we build a lot of infrastructure. What does that mean for the market? Do we create lock-in effects, or do we need that additional infrastructure because we still have a robust gas demand? What is the perspective of Bruegel on that, or your personal perspective, like always?
Yeah, thanks a lot for the invitation and the question. I mean, if we look into before the crisis, we had the Fit for 55 on the European level, and that saw that we decreased natural gas demand by 40% between 2021 and 2030. So that was already big. Now, with the crisis, we now move to the Repower EU, and with the Repower EU, this value essentially doubles to -70%. So in 2030, we only have 30% of the demand of 2021 if all this comes to pass. And there's a couple of reasons why it's not completely unrealistic to see that. I mean, we have seen it last year on the household side, 40% increase in heat pumps. We see climate change kicking in every year, 20 heating degree days less every year for the past 30, 40 years. And at some moment, we'll get into these doom loops that essentially kind of demand gets less and less, and then the infrastructure becomes more expensive, and then gas essentially gets priced out by itself. So it might essentially fall over a cliff. So European gas demand declines faster than expected in household side. On the industry side, we have seen the high prices cause some structural changes. So companies invested in energy efficiency, invested in fuel switching, and some companies closed. That will not come back quickly. We see that what Europe will buy is largely LNG at the margin, which will be more expensive than natural gas in those exporting countries, significantly more expensive, which means that companies that are gas intensive will find it very difficult to be competitive if they are sitting in Europe. So this will be a structural kind of, whatever the LNG oversupply is, it will always be cheaper in America than in Europe. And decarbonization goes ahead with very fast speed. No more free allowances in the middle of the 2030s. So European gas demand is going to decline faster than many of us expected. On the power side, electricity, the generation mix projections see that wind and PV are going to increase drastically. Question is a bit, how fast will coal and nuclear fall, and how fast will electricity demand increase? But I would presume that essentially we will also in the power sector of this bulk generation of so gas might still be very often the marginal fuel, but kind of the bulk generation of from gas-fired power plants is more likely to decrease than not. So what we are seeing is not only a price-driven development where we move along the demand curve, but we lowered the demand curve structurally. And therefore, there is a significant risk that we are going into a substantial, dramatic oversupply on the gas side. And the question is a bit, what are we going to do with that, and how are we going to finance then all this infrastructure that is being built for this gas that we kind of structurally might not need?
What would your advice to politicians to reduce the amount of infrastructure, or to go for it because we have a short-term security of supply or supply problem, and to finance or to think about financing stranded investment? What would you recommend?
I mean, a no-brainer would be to kind of plan better for the different demand scenarios. And I think we are still listening too much to the gas industry itself, that has, of course, an interest to keep gas demand projections up, and in order to justify them getting support. So we need a more independent planning process on that. We need to coordinate more in a more European way. I have been kind of spoken out and was relatively in favor of the Baltic Sea LNG terminals in Germany, because I thought they could be quite useful to help Central Eastern Europe. But we should talk to the Central East European partners whether they really like and need them, or whether Swinemünde is essentially going to be enough and can be better integrated with the German pipeline infrastructure. I mean, we have seen how valuable the European market has been in the last year, and I think it is really a testament of the testimonial of the really great success of the European market, that we managed a crisis that, in my view, was not at all lucky. We lost not only half of our gas supplies, we also lost half of French nuclear supply and a lot of hydropower. I mean, it was really a rather unlucky year for us, and we managed that without getting the market kicked out. And we need a more Europeanization of those debates, because if Germany is now going to massively overbuild and lock in stuff for its own industry, it might just kind of be a lot of sunk investments.
Yuri, would you agree that that at the end of the day, the European market will be oversized, or are you more optimistic about the future perspective of the European market as a market for gas?
So it's an interesting question. Probably demand is one of the most difficult to predict, which is coming from the fact that the large supply projects are planned for 20 years, and you kind of they have a lead time of 3-4 years. So the visibility of a large supply project, especially around LNG coming into the market, is it has a much better visibility. from a power generation perspective, we see a lot of renewables coming online continuously. It's a question if the pace can stay. We started to hit difficulties with respect to grid connections, with respect to regulatory speed. The question is if we're going to be able to grow our renewables quick enough to potentially reduce lignite and coal generation across the EU. I believe the answer from a decarbonization perspective is better with gas than with coal and lignite. Although I have to say that we should really be having a total carbon footprint also for the gas plants, assuming that it's coming from LNG, which is mined somewhere else, then is putting on is liquefied and put on a vessel, then regasified and then burnt. But still, LNG looks better. From an industrial perspective, there are certain processes which is difficult to replace with electric processes because of the heat requirements. But it's also a question of European industry. And that's also a question of global economic realities, starting with high interest rates and through let's say nearshoring geopolitical consideration.
That means
from my perspective, I just have two points perhaps to add to this. Number one is gas makes the solution simpler. So there's a lot of different alternatives considered. I believe that there's a vast gas system in Europe from a transmission and from a storage perspective. We're also building a vast LNG import structure. So if we only have to decrease the use of gas in our energy usage compared to lignite, coal, oil, which are more dirtier fuels, then I guess this is a simple problem to have right now. I believe the decarbonization problem is too complex for everyone to manage, and as such, it's very difficult for us to see substantial progress. Very, very difficult for us to understand the progress, right? Because there's a substantial amount of capital going into renewables, but we don't really see a substantial decrease of the CO2 emissions globally. So we really have to touch it. And on another point, gas is a marginal and gas is a substantial energy consumption in Europe. And just 10 euro per megawatt hour increase on gas means 40 billion euros more cost for Europe in European consumption. And right now prices are around 45. So maybe we see an annual increase in terms of total cost of the gas of 100 billion compared to the previous years, and we don't even come close to what we have been paying in the last couple of years, in 22 and the end of 21, with prices that are above 100 euro per megawatt hour for gas. So I believe that this should be providing sufficient funds in order to increase entry infrastructure into Europe, just to, from an insurance perspective, it just pays off, especially if floating terminals are built that can be, directed away if gas demand is going down as quick as one might hope.
Okay, that means you still have brighter progress for gas than many people think. Perhaps to make it a bit more concrete, what I find very, very interesting is over in the second half of October, that 3 European companies announced new contracts with Qatar Energy over a period of 27 years with the destination of European ports. It was Shell with a destination in Rotterdam. It was Total Energies with a destination of an LNG terminal in the south of France, and Eni was a destination in Italy. Jonathan, are these companies crazy to bet on such a long-term view gas which is long beyond any decarbonization targets, or is it a bit like, as Yuri says, that gas will have a longer perspective in Europe than and brighter perspectives than perhaps Georg described it? And is that part of a new strategy and equilibrium?
I mean, our work suggests that gas will have a longer life in Europe than maybe Georg described. But I think that's really, when we say a longer life, I think we're all a little obsessed with targets. And as far as we see, we don't think many countries, or possibly any countries, are going to meet their targets compared with where they are now. So I think maybe the key thing is to go through the sectors as Georg did and say what you think is likely to happen in each sector for each country. But what I would say in response to your question is, yes, they signed those contracts. I personally think that what was reported in the press is counter to the European law in terms of destination clauses. I don't think you can insist that a particular cargo is landed at a particular terminal. But let's leave that aside because we don't know what's actually stated in the contract. But what I would say is, there's been a lot of pressure from US companies on European buyers saying, why are you not signing long-term contracts? You've got a massive security of supply problem, which of course suits their commercial reasoning. But what those companies are doing, particularly Shell as a portfolio player, is Shell can sell that LNG anywhere. Doesn't need it said it will sell it in the Netherlands, but if the Netherlands doesn't have a market or there's a problem, it can sell it anywhere. And the key thing, I think, for the other contracts is, yes, they've signed them, but they're relatively small. We're talking about less than 3 million tons in each case. So there's a possibility of decarbonizing the LNG once targets really begin to bite. There's also the possibility of simply trading it away. Even if you're not Shell, even if you're NG, you can trade the LNG away to markets in Asia, which probably will have, even in 2050, less stringent decarbonization requirements. So it is a security of supply issue. It reflects the fact that the Qataris are not willing to sell gas on terms other than long term, particularly for particular buyers like the big battalions and Shells of the world. What is quite interesting, though, is if you look at European requirements for LNG as we see them, there are not many long-term contracts being signed, and the ones that are for relatively small volumes. So on a long-term contract basis, Europe is a little bit short even for a reduced demand. And I believe that reflects really two things: uncertainty about the demand that we've talked about, but also a huge elephant in the room is what will happen to the Russian contracts, which sit there for a very long time and which have to be resolved, and about which there is a kind of mass of litigation ongoing worth tens of billions of euros. And nobody knows that. At least I don't know it. But the concern of at least many in the market is these contracts will have to be honoured at some stage. We don't know when the political conditions will be right or will ever be right, but they will have to be honoured or they will have to be resolved financially, and that is going to be a very complex issue.
Kirsten, perhaps two things to add. Also, when you learned about these long-term contracts of these portfolio players, do you think it was a good news even for Germany's security of supply? And second, what Jonathan said from your perspective, as this question of this elephant in the room, is that something which makes you nervous from the German perspective, from the German downstream perspective?
Which elephant in the room?
The elephant in the room of Russian contracts that are
Yeah, sorry, the issue.
No problem.
Well, of course, I think it's good news if portfolio players build up their portfolio also into the European market. I also think we shouldn't talk too much. I mean, of course, it's an issue if we look to climate protection policies and to the targets, the issue about lock-in effects. But I would rather talk about stranded assets and stranded investments, because that is basically a major challenge. And then we have also the issue of possibilities to decarbonize, as Jonathan said, natural gas supplies. The issue about the Russian long-term contracts, I'm stepping back to what Jonathan has said before. This is really an issue for lawyers. To me, it's very difficult to look into all the nitty-gritty details. But really, I would back the analysis that for a midterm period, Europe could have the position or the situation that it's a bit short of positions into the European market. Why will still, I mean, there are very interesting developments. We are seeing the whole discussion around ramping up biogas and biomethane. There is the issue of course, the ramping up of the hydrogen value chain. So there are a lot of question marks or moving factors that we have to take into consideration. But I think, and we pointed to that several times, there is a big structural challenge, in particular for the industry in Europe, because we do see relatively higher prices compared to our if you wish, competitors like US, but also China. If we have a bunch of cheap, as you said it, Jonathan, Russian gas coming into China. So we have this structural challenge. And to be honest, this challenge is also one that we face in the electricity markets if we talk about renewables, and the same goes to an extent for green hydrogen as well. So I wonder whether we could have the luxury to think about to keep short positions into the market, because for me intellectually it's a very interesting issue to think if we are entering a period of more LNG supplies into the global market and dumping prices, if we have described it, with I think 250 BCM coming on stream till 2030, then it's really an issue whether and how in Europe and in Germany to use these falling gas prices for the transition.
But you said we're short with long-term contracts. Well, on the other hand, you say, well, there is a global market and we're getting additional supplies that bring gas prices down. At the end of the day, is it not the case that we just benefit from a global market and from a global gas equilibrium at the end of the bit, independent to what extent Europe is closing or European countries are negotiating or inking long-term contracts? At the end of the day, you all agree on 2026, we have a kind of we have a huge new supplies coming on stream. We will potentially, and this will something which will have an impact on the European market too, independent of what European companies are doing deliberately.
Yeah, fair enough. But the volumes, as it has been said, are quite not the big long-term contracts, and there are huge geopolitical challenges and possible disruptions ahead. And then, of course, Qatar is one to look at too. I think it doesn't hurt to have.
Okay.
Some portfolios players looking into long-term contracts into Europe.
You're a Eurowatt one of these portfolio players. Do you think Europe is short on long-term contracts, and therefore you're going to fill that gap with more long-term contracts, or do you think, well, the risks are too high, demand destructions might be too high, let's rely more on short-term markets?
So I definitely believe that more long-term contracts are needed. Europe is by far the region that's most relying on short-term contracts. So if we're looking at pipeline, maybe except for part of Algeria, all of European long-term contracts are spot indexed. So I'm not sure if this would have any long-term pricing impact. So then if we are seeing a few shareholders of Qatari trains signing contracts, which we don't know if it's indexed to gas or if it's indexed to oil, the only real indexation which resembles some difference to spot market index is Henry Hub-based LNG prices. So we believe that if baseload is missing, then we would need to plug it with baseload. And if we're just relying on short-term European price moves, which if we look at exchange reports, for example, is dominated not by commercial players, exchange prices, but more by investment funds who are taking a position on the market. And I believe that the power of having long-term indices linked to costs, and to a certain extent, this is what American LNG export contracts are looking at, should have at least a basis 20, 30, 40% role in the European forecasted import mix.
But who is going to sign these contracts? And you are going to do that, or you signed one contract for 1 million tons with an US terminal, or is that contradictory to what Georg said holds to some extent, that the demand is insecure, or demand projections are at least very, very difficult?
So yeah,
do we need some state support for these kind of contracts, or?
So listen, let's face the reality. If 80% or 90% of European energy is imported on short-term indices, then we are to a certain extent also at fault in huge price swings. That's just the reality. So the fact that the German TSO, for example, has bought a number of LNG cargoes in order to fill it into the storages, might have made the market spike for a few months or days, because they just bought up every excessive LNG cargoes in the world. But it has largely contributed on a few spot cargoes to full storages and more depressed prices all over Europe for a more prolonged period of time. So there is a point when the question is good: who should run the risks of 20 years, 15 to 20 years supply? But maybe we should also reverse the question: is 20% of your consumption in Europe as a whole linked to some long-term indices the risk? Or is leaving 80% of your total consumption subject to daily or front-month pricing index the risk? And this is when I'm coming in. We're not a trading company from a perspective of risk speculation. So we're not a hedge fund. We're a physical trader, meaning that we move the molecules from LNG or from power generation to the customers. What we are seeing is that you have to have a balanced risk portfolio. A part of your portfolio should be on a cost-plus basis, which is reflecting the entire industry's upstream industry's economics. And yes, you can have a part of your demand on a short-term index basis, and some managed as a hedging by some fixing exercise along the forward curve. But to leave 80% of your total demand, and as such, the health of your industry, subject to short-term market movements, which are totally out of your hands, I believe that's risky.
Okay, that's because I'm looking at the watch. We are almost a bit running out of time, and therefore I'm going to make a very short wrap up and to see where we go from here. The title was Global Gas Market and Transitions. You all agreed that to some extent we are through the crisis situation and are now moving to a kind of unstable equilibrium which is characterized by rather high volatility due to exposure to LNG, and the question of the role of demand destruction and decarbonization efforts on the sides of the market and of the development on the market. I think this is description of the current situation. You disagree to some extent what will be the future development of demand, whether we will have a kind of quick decarbonization or a deindustrialization due to a movement of industries to where the commodity is produced. And this is what I understand, what I find important is this is a very important factor for the future market development. What will happen with demand and how quick will we have demand reactions in Europe? The other point is from a supply perspective, to some extent, we will have a kind of rebalance perhaps of Russian gas, which is sold in other parts of the world. To what extent this will take place and how long it will happen is a bit of uncertain. And I think there is an agreement, at least I asked Georg in a second on this, that we need more long-term LNG contracts, but it is completely unclear to what extent they will really inked in Europe and to what extent the risk appetite of players is large enough to go for these kind of contracts. What I find an interesting remark from Yuri is that we need contracts. What is important in these kind of long-term contracts is indexation, whether you move away from spot indexation to a kind of cost-based indexation, which, to be honest, from a point of an trained economist, makes me a bit nervous. But I think that's something we will not discuss in this session on more detail. Yuri, I hope we have the opportunity to discuss it later on. But Georg, because you would from your point of view, is that the question of long-term contracts in a declining market? Is that something which is important for the European equilibrium, for the future equilibrium?
The question is how much of these contracts, right? I mean, a few BCM, of course, but I mean, again, the numbers, if you see LNG import capacity predictions for Europe, 400 BCM plus pipeline alone from Norway, 120 BCM, and you put in context to that the kind of Repower EU, which we might discuss, with 140 BCM. I mean, it is actually, if that comes to pass, if the Repower EU plans are there, we don't need zero LNG imports. It's all going to be pipeline, which kind of, we can all disagree, but we can look into the numbers. But it's going to be extremely difficult to say how much LNG contracts internationally we have to sign, and we need a very well-informed debate on that. And of course, everybody has strong interests here. The Americans that want to sell us LNG, the European industry, gas industry that want to keep their business model. And I mean, they are all being there, and we need some informed debate. So I found Jonathan's comment that we need to go through those things on the demand side one by one and have a fair debate on that, very, very helpful. And I don't actually see where this forum to do this is going to be. especially as this is not a purely market-driven thing, because everybody is calling for some sort of state guarantees or state support to keep their business model, and we don't know how much demand actually will be there. A second kind of long-term point that I would kind of raise is there has been a new paper by Tom Brown who essentially wrote that, yeah, well, actually we might not need LNG and we might not need hydrogen, but actually methanol is the thing because it's much easier to store. And if you anyway have abundant energy outside of Europe, then let's do it all liquid. It makes things much easier. And the third point on the long-term contracts, and that's where I show my ignorance, my understanding would be that in the oil we import kind of a large share, 95 or so % of it. And I'm not sure how much of this oil is actually in terms of long-term contracts that are based on production cost. I would think that this is a rather kind of spot market driven thing, but I might be wrong on that.
Okay. Jonathan, once I started with you and I finished it with you. One last sentence, which because it's one thing I did not really mention in my wrap up. To what extent the gas market may switch to a market of green molecules? Is that something which is becoming new, getting a new momentum over the next years? What Georg now mentioned and what Kirsten mentioned in particular, that biomethane or hydrogen will be dominating the market, let's say in 2030, and natural gas will have a minor role. You have minus 30 seconds.
Definitely not dominating the market, and definitely not by 2030. We'll have a larger role in the market. We see hydrogen more in clusters than in a kind of widespread function. But I think the key thing is that emissions from the natural gas sector, particularly methane emissions, are now getting a lot more attention, and that is going to be very important. But I see low carbon gases having a bigger role as we go through the 2030s, and that will mean either decarbonizing natural gas or developing these new sources like green hydrogen and biomethane.
Okay, thank you very much. I think that was one point you made also, that the question to take into account the emissions over the whole value chain as far as I understood you. Thank you very, very much, all of you, for this very lively discussion. I did my wrap up even a little bit earlier. Hope everyone can agree with that. That means we will have a very, very interesting next years, which are hard to predict, which have that huge challenges, but also perhaps the opportunities, and perhaps we will have the opportunity to discuss that in a later event. Thank you very, very much, all of you, and goodbye. And then I hand over to Anne again.
Yeah, thank you very much, Heiko. And thanks to all of our panelists. It was a very exciting discussion. And as you said, there's still so many things to continue a talk and to continue the exchange. I think I read down a few things. So there's question marks, there's elephants in rooms, and there's potentially green molecules. So yeah, just a few things that you've touched upon, and that can be continued maybe during eWorld. So maybe we will meet in February in eWorld in Essen and see each other from face to face. That would be great from my side. So yeah, thank you to you, Heiko, for preparing this event. It was a real pleasure, and thanks to the four of you for taking your time and for being with us today and sharing your views. So in the meantime, anyone in the audience, if you have questions or comments, concerns maybe, or praise, just give us feedback. We'd be very happy to see that. And I'll just slide share where you can find us by email or by social media. And also to just quickly give you an outlook on tomorrow, we will cover another gas-related topic, at least in Germany, as we also discussed here. That will be heating. There will be a short presentation and then also a panel discussion on how to design a municipal heat planning successfully, hopefully. So I can't wait to see you there. And just before we stop, just a quick thank you to all the people behind the scenes who have been working to make all of this possible. So there's our events and communications team who have invited everyone. There's our design department who have come up with wonderful video graphics, and the 2 technicians who have been working to put everything in such a wonderful and nicely working stream for you. And finally, there's our wonderful 2 technicians. Technicians are also wonderful, but also wonderful are our interpreters who have brought this event also to life in German. So thanks to all of you. And with that, I wish you a wonderful rest of the day, and I hope to see you soon.